I want to go over some of the basic information as far as accounting for receivables go, and looking at different types of receivables that we have out there. So some of the receivables that you will see on your balance sheet, you will have, of course, accounts receivable, which we've talked about already. Other items that you'll see are notes receivable. These would be claims for which a formal instrument of credit has been issued. They could be 60 days, 90 days, could be longer. They do require interest to be paid, and there is normally a promissory note associated with this amount. When we look at trade receivables, these would be notes as well as accounts receivable that are from our sales transactions. And then we do have other receivables. These would be non-trade items. They could be interest receivable. It could be loan to officer, advance to an employee, or a loan to an employee, a tax refund, anything like that can be part of these other receivables. These are all current, or for the most part, all of these can be current assets. That note receivable, if it's over 1 year, then that could be a long-term investment item. But for the most part, we're dealing with current assets here. Now, when we look at accounts receivable, we have to look at how we value accounts receivable, because accounts receivable must be recorded at the net realizable value. In other words, what this is saying is what we expect to receive from customers is what it should be valued at. And inevitably, what happens whenever you have an accounts receivable, not everybody is going to pay you the full amount. And so since they don't pay you what they owe you, we have to actually look at dealing with this non-payment through two different methods. The first method is the direct write-off method. The direct write-off method is not in conformity with GAAP. This is something that a lot of small businesses use, and when they realize that a debt is not going to be paid, they simply write it off. And so it's bad debt expense, it's accounts receivable. The second method that we will look at is the allowance method. Now, with the allowance method, this is in conformity with GAAP. What it does is we do an adjusting journal entry at the end of the period, and we match that bad debt expense with the time period in which the money has been earned. And the account that we use for this allowance method is going to be the allowance for doubtful accounts. So that is an account. That's a new account. And this is a contra account to our accounts receivable account. The other thing that we look at with accounts receivable is selling our accounts receivable. So if we really need money in, we may look at selling our receivable to another company for cash. What this does is it shortens the cash cycle. So, and they can be sold really to get more cash in. Billing and collection could be very costly, and so we could go through and look at that. I do not advise against selling your accounts receivable because it can be very, very costly. I've been in situations where you are looking at that it could be a 1% all the way to 3% of the receivable purchase. And if you do this, they generally set it up to where you have to factor every month. And so let's just say that, we're factoring $100,000 and we're at a 2% rate. So what that is saying is, I'm paying $2,000 to factor this $100,000. Well, that's not too bad. I'm getting the money in, right? But if you're in the situation where you have to factor $100,000 every month, then by the end of the year, you are paying $24,000 to factor that $100,000. You could have gone out and gotten a loan, if it's possible, for $100,000 for a year, and even if it was a 6% loan, you would have paid $6,000 in interest and not the $24,000 that you end up paying with this factoring. So that's why I don't recommend looking at the factoring. But there are a lot of people out there that actually do the factoring, and they use it. The other thing to look at are the credit card sales. Now, with credit card sales, there are 3 parties involved. You have the retailer, you have the customer, and then you have the credit card company. Generally, what we do with credit card sales is we do record those as a cash sale. However, the credit card company does normally charge us a fee. And so we're not going to get the full amount. So let's just say that, we have $1,000 sale, and the credit card company charges us 3% to actually use this credit card, or to take or accept this credit card. And so it would actually cost us $30 to accept their credit card. So the amount of cash that we're going to be getting in would be $970, because the credit card company is going to take their fee. And so they'll either take it up front. Some credit card companies take it directly out. Other companies just charge you a monthly fee once a month. But in this case, if we just take it out, and then we have the service charge or the credit card fee expense out there for the $30, and then we have, of course, our service revenue, our sales, whatever we're looking at, for that $1,000. So we do have to take it out, but it is recorded just like we would do cash. Is what we're looking at there. Now, for note receivables, again, these are generally promissory notes. It's a written promise to pay. It's a specific amount of money, a demand for a definite time. In that promissory note, it will tell you the interest rate. It will tell you when it's going to mature. It also tells you the amount, the principal amount. They also do have that interest that will be collected on them. The way we calculate the interest is we take the principal amount, we multiply it by the annual interest rate, and then we would multiply it by the time period that we're looking at and come up with that interest amount. When looking at this from the receivable side, remember receivables go with revenue. And so what we will see with this is you would have an interest receivable amount when you accrue this, and then you would have the interest revenue. And so when we look at accruing the interest, if it's not all paid, let's say at the end of the year, we've accrued it, then this would be the journal entry that you would see whenever we're looking at the receivables and the revenues. I'm going to go ahead and look at the payable side also real quick, because with that payable side, that would be looking at an expense. And so if we're looking at the payable, note payable, you would actually see something a little bit different. You would see an interest expense and an interest payable. So these are actually calculated for a note receivable and a note payable are calculated the same exact way. So the actual calculation is done the same way. It's just the journal entry would be a little bit different. The other thing I want to look at is that statement of presentation. So this would be on the balance sheet. As I said, you do want to look at that net realizable value. So what you would have in the current asset section of the statement, you would have your accounts receivable, and let's just say that it is at $100,000, and then you would do less the allowance for doubtful accounts, and let's just say that that was at $10,000, and then you would have your net realizable value would actually be figured at $90,000. And so that is what your balance sheet would look like whenever we're looking at this net realizable value. So those are just some of the things to look at as far as the chapter goes on our receivables.